Hello and welcome to our latest Insider interview. Today I have with me Simon Holmes, who is fund manager of the BMO Sustainable Universal MAP range. Simon, thank you for joining me today.
Thank you for having me.
So Simon, three of the funds, balanced, cautious and growth, could you firstly run through how they differ from one another?
Yes, well I think what I'm actually going to do is to start with the similarities. They're all part of the universal range that we have. That range is up to 1.5 billion now. And one part of that range is the Sustainable Universal MAP range. And under that, we've got this cautious, balanced and growth funds. Now, all of our range is designed to bring active management, and in this case with sustainable focus, at fees which are very close to a passive price point to our investors. And what we want to make sure is that they can invest in line with their values, but without having to compromise on, for example, active management or expensive fees. And actually, again, each of those funds is built from very similar underlying asset classes. So we've got sustainable global and UK equities, we've got sustainable credit, and then we've got government bonds and cash. And it's really those same building blocks. But where they differ in the amount of risk that they're targeting. So the easy way for us to do that is a more aggressive fund, if you like, will have a higher allocation to equities. So the growth fund of the three has the highest equity weight. And the more cautious fund, in this case cautious, will have a lower equity allocation and will have a higher allocation to fixed income.
Sustainability is at the heart of the investment process. Which types of companies or sectors do you not invest in? And what sort of ESG qualities does a company need to have in order to win a place in one of the funds?
So we have a framework for sustainable investment, and we call that Avoid, Invest and Improve. And this really helps us to pick the right names we want to own and to make sure we don't go and own something that we don't think fits. And under Avoid, this is really about excluding. And what we're looking to do is to not have companies that are involved in sectors such as tobacco, such as weapons, and most importantly these days, fossil fuels. And we also don't want companies that seem to have really poor conduct. So maybe the thing they do it in a really dirty or wasteful way. And we don't want companies that seem to have poor governance either. So where the management of that company doesn't really seem to manage the outcomes of the company well. So that's the avoid part. But most important to me in terms of this framework is the invest part, because for a fund, a sustainable fund, that's where we really want to find good companies which are actually aligned with a sustainable future. And so under this, there are so many different themes that are interesting. For example, you've got the climate transition going on, so things with renewable energy or clean energy and so on. But also it's not just about environment. So there's social aspects like healthcare, improving the creation of food at an affordable price, but with good nutritional content, and many others too. So much of our society is really driven now by needing to make that change. So cities, for example, or transport, or even sustainable finance. These are all the sorts of names or themes you'd find within our portfolio. The last part of that framework I mentioned, Avoid, Invest, Improve. The improve part is about engaging with companies, and the summary of that is we want to talk to those companies that we own about how, even if we love their product, some of what they do could be done perhaps in a better way or a cleaner way.
There's plenty of debate around mining companies about whether they should be in a sustainable portfolio or not. Where do you sit on that debate?
Well, it's a very interesting area, I think. So it's not something that I think one can just exclude from the portfolio. I think mining allows us to get access to metals and minerals, which are going to be really important for the transition to a cleaner economy. If you think of some examples, so electricity itself is conducted by copper. So if we're going to become more reliant on electricity, we need access to copper. Steel is used in the production of wind turbines for wind farms. And then cobalt or lithium, to give two more examples, both of these are used for electric vehicles. They needed to make batteries. So to me, it is important to find a way to access these metals and minerals, because if we don't, we will be completely reliant on fossil fuels for a long time. So therefore the question is, how does one do this well? And I think what we're looking for is those comparatively well-run mining companies that understand they need to invest to really make sure they're doing their job cleanly, responsibly, not just about ecosystems, but also about communities. So what we absolutely don't want is some sort of coal miner or a company that's mainly a coal miner making some new coal mine near the Great Barrier Reef, something like that. That would be very damaging. Companies that we like, so one that we hold is called London Mining, which is focused on extracting copper, but doing it in a way where they're trying to be cleaner. They're trying to do that responsibly. And then there's also other sort of related names like Umicore. Now that isn't a miner, but what they focus on is taking complex waste, maybe from things that have already been made and used, and then extracting from that waste material precious metals that can be used again. And that, as well as providing access to those minerals or metals, it relates to the theme of a circular economy.
You mentioned earlier engagement. How do you engage with companies, and are there any particular ESG issues at the moment that have become more prominent that you're asking companies about?
So yes, engagement, if we come back to the framework I mentioned earlier, that's under that third part called improve. And it's really important we think, to engage with those companies that we own. So they may make a great product, but they're unlikely to do everything perfectly. So what we mean by engagement is we talk to management, we try to share with them what we see as best practice, perhaps in their sector, and then we might work with them to agree targets that they can work towards, maybe implementing a new policy, maybe improving their cleanliness, if you like, of the way that they operate, and setting those targets. And when they meet a target that we've agreed with them, we would call that a milestone, and we record that as a good outcome of our engagement process. Often, we will do this on our own, but we'll also work with other investors. We find sometimes collective action really helpful. So there's a body called Climate Action 100, which we're part of, and that's also been very good. To give a couple of examples, so one name that we own is called Smurfit Kappa. This company creates, it's a specialist in paper and cardboard-based packaging. So if you think of all those things in the supermarket that are there, all the food, when that's all plastic wrapped, then obviously that's not really very consistent with sustainability. So cardboard or paper is much better. But they're still a big industrial company, so they're an intensive user of resources and energy. So we worked with them to create what are called science-based targets, which says, what sort of targets should they have for their use of waste and energy that are consistent with keeping the global temperature down in a way which will sort of enable temperature not to go up more than 1.5 degrees. We worked with them on that. They then set some targets. We viewed that as a good outcome, a milestone. Another example might be Kerry. That's an Irish-based sort of food company, and what they do is they come up with formulas and ingredients which enable many food products to be made in a much more nutritious or cost-effective way. So that's clearly good when you think about trying to allow access to poorer people to good food. But a company like that will have a long supply chain across different countries. And so we worked with them, for example, on how can they improve or make sure they're not doing things such as deforestation in a bad way. How can we make sure that they're not accessing palm oil in a bad way? And even things about the workforce. So most companies will have an anti-slavery statement, which just sort of embeds the fact that they don't want to take workers on unfair terms. And obviously they were very happy to work towards such a statement because that's not what they do. But having that statement is helpful. So those are two examples where we think our engagement has helped lead companies that we really like, but to slightly improve some of their practice.
Has climate change become an increased focus when you're speaking to company management? And could you give a couple of examples of climate-friendly stocks that you invest in?
Yes, so climate change has been something on our agenda for a long time. When I was talking about engagement just now, so we have a whole range of different areas we look at. Climate change was there, but also environmental stewardship, public health, human rights. They're all important things, but we've absolutely seen an increase in focus on climate change. If you think about what everybody talks about these days, net zero and how are we going to get there. So that is an absolutely important thing. One of the names that we like is a British utility called SSE. Now, they've really decarbonised their whole approach to generating energy. They're very focused on renewable energy. So that clearly is a good fit for the portfolio. But they've also recently released a just transition strategy. And the just transition is about saying, look, we, the world, have to get to this better place, but we also make sure, if we can, that we're doing that in a way which doesn't completely disenfranchise workers or communities and so on. And it's about that balance of making sure we're doing the right thing, but in a way which includes those people that have been relying on those companies. Another good name for us is Ørsted, which is one which comes up a lot. It's a well-known renewable company these days. If you go back 20 years, it was a Danish state-owned energy operator, just completely traditional, fossil fuels and so on. In 2009, they started on a journey to completely change the way they work. So they got rid of all of those fossil fuels and their reliance on that almost entirely. And now they've become focused on wind farms, and they're the world's largest operator of offshore wind. And offshore wind is is cheaper and cleaner, clearly, than traditional forms of energy.
Simon, thank you very much for your time today.
Thanks for having me.
That's all we have time for today. Please do check out our YouTube channel for the rest of our Insider Interviews video series, and please do give us a like and subscribe. See you again next time.